Hi guys, it's Jonas here, and today we'll look at how to buy and hold as the stock market crashes to become a millionaire. We will try to answer 3 questions which are particularly timely today. First, when you should start investing. Second, how much you should save and invest every month. And third, what level of returns you expect to achieve on your investments over the investment period. When I decide on how to go about doing something important, one great way to help me arrive at the right decision is to write down the pros and cons of a particular decision. Having written them down, the answer often becomes obvious as the facts and feelings are separated into a more understandable and comparable form. But what if you have a particularly important but more complex decision to make than a simple yes or no? In considering how to buy and hold with the stock market crashing to make your million, we will answer 3 questions. When to start investing, how much to save and invest every month, and what level of returns you achieve on your investments over time. Even after simplifying our investment strategy down to only 3 of the most important questions, deciding between the remaining options might still seem daunting. Luckily, we can borrow a great tool used in operations research called a decision tree. A decision tree makes complicated decisions like this easier to understand and, more importantly, is a more visual way of exploring and answering the questions. Let's take a look. Pretty, isn't it? But this isn't just a flower. This is actually the product of quite a few hours of number crunching in Excel and trying out different visualization software. So there are 3 things you need to understand about this decision tree for this to make any sense. First, the basic units. A circle represents a decision you have made, and an arrow represents a possible path from where you are to a future reality. You can take any path from the middle to the edges, but there is no retracing your steps once you have moved on to the next circle, except for us today. So stick with me to the end of the video to find out how to buy and hold as the stock market crashes to become a millionaire. Second, you may notice that some circles are solid and others are just an outline. These tell you whether the decisions made up to that point led you to becoming a millionaire or not. The solid colored circles indicate that becoming a millionaire is still a possibility, while the empty circles tell us that we have failed to meet our goal. Thirdly, the colors themselves. Each color represents the question we are answering at that circle. Green is our answer to the first question, yellow is our answer to the second question, and magenta, here around the outside, represents our answer to the third question. So we begin our quest for the best investment strategy. The premise of this decision tree, or decision flower, if you will, is written in the blue circle here in the middle. Looking back 30 years from today, will you succeed in becoming a millionaire or will you not? So given that question and goal of being a millionaire 30 years from today, our first question to answer is when to start investing. Because putting off saving and investing for 30 years would leave us with $0, the first logical choice we have is to continue spending all we make for the next 20 years and only then to wake up and frantically start saving for the final 10 years before our goal date. Let's say we made that decision and take a look at the next branch in our decision tree. How much you save and invest every month. The choices are $100 a month, $500 a month, or $2,500 every month for those final 10 years. If again we take the easy route and save $100 a month, there are 3 points we can end up at financially. The third decision is what level of returns you achieve on your investments over time. You might ask, Jonas, how is this a decision? Of course I want a 1,000,000% annual return. To which I would simply say, no, sorry, that's impossible. We could really spend a lot of time on this discussion, but even if you did choose the right stocks today in the market downturn and beat the market going forward by even 10% for the next couple years, statistics tell us that you are not likely to continue to do so for the rest of those 10 years. For long-term returns, the marginally better returns that may be possible by timing the market or choosing the right stocks are irrelevant on any time scale long enough to create meaningful levels of wealth. But Jonas, what about mutual funds? For example, the best mutual funds have beat the market index by about 3% over the last 40 years. Isn't that long-term returns? Yes, it is. So we will take that tiny possibility that you succeed in making the mutual fund pick of the century into account. Also, we will consider the choice of either investing in the long term with a more risky strategy that doesn't end up paying off, or a more conservative strategy like using bonds or real estate in your portfolio, rather than simply investing investing in stock market index funds at a 10% annualized rate of return. With poor returns, we'll assume you'd end up with 3% less than the market at a 7% annualized return over the long term. These three choices give us totals in year 30 of $17,000, $20,000, and $24,000. Not a huge disparity between these three, and less than 3% in any case of our $1 million goal. As you may have noticed from the outlined circle, the decision circle of starting investing only 10 years before our end date has already made it impossible to reach our goal, regardless of the decisions we make from here on out. However, we can note that by starting our investing 20 years from now, we could still put together about $100,000 by investing $500 a month for only 10 years, and in the ballpark of $500,000 or halfway to our goal of $1 million by really cranking up the heat and investing $2,500 a month for those last 10 years. So we know that as far as becoming a millionaire, starting 20 years late is not a winning strategy. But what if we live paycheck to paycheck for only the next 10 years and turn a financial corner 10 years earlier? What if we give ourselves 20 years to build wealth and become a millionaire? With this choice, things are looking better right away. Even by investing only $100 a month, we would end up with $75,000 on an index fund return, and about 3 to 5 times what we would have with the same investment starting 10 years later. However, we are still at only 5 or 10% of our goal of $1 million. With 20 years of time to save and build wealth and a $500 monthly savings rate, we end up with a range of $250,000 to $500,000 at the end of the goal period. Not bad, but not yet a winning recipe. However, having sat out on saving for 10 years and then having invested $2,500 a month for the next 20 years would put us above $1 million regardless of returns. A poor but steady 7% return would build a portfolio of $1.3 million. An index return of 10% would put us at a cool $1.9 million, and a high return, having made that mutual fund pick of the century, would put us at a sweet $2.8 million in only 20 years of investing. But then we come to the exciting part. 30 years from today, had you made the decision to begin investing right away, what I really mean is had you start investing today and you had invested $100 a month with even poorer 7% returns, you would have $120,000. Index returns would have brought you $220,000, and great 13% returns would leave you with $430,000. All this with only $100 a month. Importantly, however, none of these scenarios are winners here, because the goal was to become a millionaire. By starting today and saving $500 a month, even with poor returns, say by trying to time the market or chasing that extra $1,000 return in a bear market, we'd end up with 60% of our goal with over $600,000. However, had we stuck with the plan, saving $500 a month, beginning today as it were, we would be at $1.1 million. The 13% return would put us at $2.2 million, which is pretty awesome. Lastly, and unsurprisingly, hitting our goal out of the park by saving and investing $2,500 a month for 30 years, we would have a range of $3 million to $10.9 million with a 7 or 13% annualized return, respectively. And with an index return, we would be sitting at an awesome $5.7 million in the bank. Now that would be pretty sweet, wouldn't it? So all in all, using this decision tree and the 27 total outcomes I calculated for you, we can see that only 8 of these decision routes led to $1 million net outcome. Having explored these successful and unsuccessful outcomes in our decision tree, how would we answer the questions we set out to explore? Namely, when to start investing, how much to save and invest every month, and what level of returns you achieve on your investments over time. First, when to start investing. This was perhaps the most important decision, as delaying the investing for 20 years eliminated the chance of attaining the goal. I have made this point in the previous video, but it is so important that it is worth illustrating. Second, how much to invest. This was about as important as the first, but perhaps a little more difficult to pull off. For example, to make up for starting 10 years late and still hit $1 million during the goal period, you would have needed to put in $2,500 a month. You will also notice that saving only $100 a month for any of these periods, 10, 20, or 30 years, is not quite enough to come up with that $1 million. Third, we looked at what level of returns you achieve on your investments over time. While personally, I find different levels of returns interesting and also clearly important enough to bring into this discussion, returns are the least important of these three questions posed. In our decision tree analysis, only one circle was eliminated by lower than average return, while market returns fit the bill and even in that scenario put us over the $1 million mark. At the beginning of this video, we talked about how to buy and hold as the stock market crashes to become a millionaire, and specifically when to start investing, how much to save and invest every month, and what level of returns you achieve on your investments over time. While making a huge percentage return on, say, a $1,000 investment on an undervalued airline or oil company today would make a great story, I'd suggest you think hard about what you're after. If you want excitement, that's fair enough. But if you are looking to meet a financial goal with good returns, a buy and hold index fund strategy will provide investing success towards a long-term goal. The reality is, and as our decision tree illustrated, what matters most in investing is that you invest beginning today and that you invest a meaningful share of your income every month. Doing those two things consistently, you will beat market speculators who are in it for a quick win by a long shot. Wherever you are on your path, get started. Wealth is not only for the few and fortunate, but for everyone willing to make their future a priority. By starting saving and investing today, you can save yourself hundreds of thousands of dollars and ensure a future filled with choices and possibilities for yourself and for those you love. If you want to know more and to get started, please follow the link in the description. If you found this helpful, please do me a huge favor and hit that like button. It really helps with the YouTube algorithm, so I appreciate you helping out. If you haven't yet, go ahead and subscribe and hit the bell icon to be notified of future videos. What are your saving and investing goals? If you have a story you'd like to share about your own saving and investing experience, leave a comment on that as well. I'll be sure to reply. Thanks for watching and see you next time.